Hello, and thanks for tuning in. This is Holly with Guilds with Benefits, and you're watching Demystifying Retirement with Chaim Schramm, and I will hand it off to get started.
Excellent. Well, thank you. My name is Chaim Victor Schramm of Chaim Investment Advisors, and I have been a wealth manager for the last 11 years in Oregon and California. I'm a fiduciary relevant to this conversation, specialized in fiduciary practice around retirement, which is how you meet your obligations as an employer when providing uh, retirement services to employees. So I do a lot of work on that end, but also a lot of work with self-employed therapists and other self-employed folks on planning for retirement. So that's kind of my specialization. And I like to introduce folks to the big retirement conversation by talking about the main tools that you have available to you as self-employed folks. One of the cool things about being self-employed in terms of the financial outcomes is that you have some of the best, cheapest, most generous in terms of contribution limits, and most flexible in terms of investment options, retirement plans out there. Uh, Also, you have a lot of choices compared to other folks. There are so many different things you could implement, and they all have advantages. So I'd like to introduce the topic and hopefully clarify some of the stuff that people are not particularly clear on, or it's hard to figure out via Google, frankly, what the real rules are around this stuff, and talk about those. And then I'll talk a little bit about some of the providers too, some of the popular providers of these. So that's kind of the two layers to how I like to introduce that topic. So there's three main ones that folks should be aware of that are specific to businesses. So self-employed folks of any variety, LLC, S corp, sole proprietor, whatever it is, can use these. The SEP IRA, the simple IRA, and the solo 401k. And then there's two other ones I'll just briefly touch on that are really relevant to entrepreneurs too in different situations. One of them is individual IRAs, which I think kind of gets glossed over by a lot of people in this conversation. And then taxable savings accounts, people often forget to think about that. And so I will talk about how's that relevant to retirement planning a little bit, and they'll give you a lot of information. And so SEP IRA is probably the single most popular for people who are self-employed and they don't have any employees, because it is the easiest to implement of all of the options out there, and it is the cheapest. It functionally is free for most people at most brokerages anymore in 2025. There really isn't a cost to operating a SEP IRA. The maximum contribution limit potentially is 70,000. That's the hard cap on the most anybody could put in a SEP IRA. Extremely high compared to what most people have. If you're a W-2 employee and you have a 401k, it is less than half that. So very generous in contribution limit. The way it's calculated is kind of funky for some people. It's 25% of adjusted net income, which is a fancy calculation that I'm not going to get into today. If you're really interested, you can hit me up and I'll explain it. But basically, you adjust your net income, how much you made as a self-employed person, or half of self-employed taxes. That's what that means. It's easier if you're S corp to know what the maximum contribution is, because it's 25% of whatever you say. This is me as employee. That's what you get. If you pay yourself $100,000, $25,000 is the max, for example. The advantages are the flexibility in timing. Here, you can make a lump sum contribution. So you don't need to be putting money every single month. towards your SEP IRA. You can do it at the end of the year. You can do it at the tax filing date. So April 15th, if you are an individual LLC, for example, you can wait all the way till April 15th of the next year to get around to doing it all at once, backward looking for the previous year. Or if you file an extension, you can do it like 2 days ago, October 15th, the following year. So extremely flexible, most flexible options in terms of timing, really high contribution limit for a lot of self-employed folks, big advantage. It's the easiest to do, and that's hard to overemphasize. For a lot of people, they open up their brokerage-based SEP IRA at Vanguard or Schwab. They put money in one time a year. That's it. And it's very easy in terms of administrative and reporting to the IRS. Easiest of all these possibilities, and cheap. So almost nobody charges any money for these anymore, like we said. That's fantastic. And then the investment options, somebody like me cares a lot about this. For some people, this isn't center of your focus, but you can invest in pretty much anything that you want. You can invest in anything that trades on the New York Stock Exchange. And that's not true of all retirement plans. Some retirement plans, you got to use 401k based options that are mutual funds of specific share classes. Here you can buy any exchange traded fund, any stock, any bonds that you feel like buying. So there's almost no restriction on what you can do with your money. And the main con of SEP IRAs for some people is the way the maximum contribution gets calculated. It's structurally below the solo 401k in terms of what the true maximum you can do is. And we'll see exactly why when we talk about the solo 401k. It's almost never going to be identical unless you make about 270,000. So for most people, the solo 401k is going to have a little bit of advantage in maximum contribution. And the other disadvantage it's going away, it's getting better, is that the IRS just reformed these very recently. So you can make Roth style or post-tax contributions. And if you're a person who's really into Roth IRAs and paying your taxes now and never paying them again, it's legal to do a Roth SEP, but most brokerages still haven't implemented that option. So they just aren't offering it as an investment option. That's a little bit of a drawback that's going to get rolled out over time from pretty much every brokerage, though. So that will become less of a problem, I think. So SEP IRAs, popular for good reason. Simple IRAs for folks who have employees, especially just one or two of them that are W-2, are also extremely popular because they have pretty good contribution limits. So obviously a lot less than the SEP IRA at 16,500 for anybody under 50, a little bit more. If you're above 50, it's an extra 3,500. So it is well above what an IRA would give you. It's a little bit below what 401k has. But in terms of flexibility, it's got a lot of the same rules for investment options that a SEP IRA would have. You can buy pretty much whatever you want. It has higher contribution limits for pretty much everyone than an individual IRA in all cases. Also, if you happen to be partnered or married to somebody who has a high income and a IRA would not be deductible for you, and your accountant says, don't put it in the IRA, this solves that. These are always deductible, no matter what income level your spouse has. And that's an advantage, too, for a lot of self-employed people. Inexpensive is possibly an understatement because it's also free in most cases. It's much, much cheaper than any 401k option out there in terms of the cost. For most people, it's basically free. And then the main cost for most employers is they pay a matching percentage to your employees. So if you got two employees and they both are participating in the plan, you have to match either 2% across the board of their compensation or match 3% of their salary maximum in contributions. So this is the main cost. It's a deductible expense, though. So for a lot of businesses, it makes good sense to offer this. And you also get to have that match as an employee if you are mostly self-employed. You get that from your company. That's an extra amount. If you have W-2 employees at all, this is like one of your top options out there, especially for Oregon and California folks, where the states actually require you, if you have employees, to have a retirement plan in place. Among those states, this has become the go-to for a lot of folks. Main con is that it's just frankly more to do than a SEP IRA. Basically, anything will be, but it's notably more in that you have to write sometimes a physical check every single month, which is pretty annoying. You also have to send in a worksheet on how much goes of the check that you write to each employee. That's true whether you use Gusto or any bookkeeping software, they're all going to do this. And pretty much every custodian, every brokerage does this too. So that's just a little bit more headache, and it has to happen every month. So there's not the flexibility of a SEP IRA to like wait till frankly like better part of next year to deal with it. So it's something that's just going to take more consistent action. The lowest possible max contribution of all of these plans for folks who make a lot of money. If you make 165,000, for example, you effectively have a 10% of your income as the max contribution to this. And that's for a lot of people not a problem. Even saving 16,500 is in 2025 awesome if you're doing that, frankly, but it is admittedly below the other options. And then it's salary reduction style, which means every time you run payroll, you're making the contribution. So there's no room for those low lump sum, throw a bunch of money at the end of the year for tax reasons. Sadly, not an option really with the simple IRA. So some inflexibility, but if you've got employees, it's your cheapest, easiest to deal with because 401ks are actually a whole nother order of magnitude more stressful to deal with. If you do have W-2 folks, solo 401k, competitive with the SEP IRA. In fact, for a lot of people, they don't actually know the difference between them. The main difference that I like to highlight for most people is the way that we get to the $70,000 max. SEP IRA, solo 401k always have the same absolute maximum. The way you get there is calculated a little different for 401ks, solo 401ks. You have 23,500 maximum contribution for yourself as the employee. So that's you saying, I'm employee, this is my slice of the contribution. So you get that plus 25% of the net income of the business. And so for almost everybody, this is going to be a little bit more than the SEP in terms of the max contribution as a result. So it structurally has that advantage for folks who really want to save a lot of money. And unless you're making, closer to 300,000, in which case they're the same. There's no difference. The employer slice of the contribution, so this is one of the pros, is not tax FICA tax. And so when people sometimes ask, they say, "Hi, should I do more as my self-employee or more as my self-employer?" Most people are going to lean towards employer because uh, you don't pay the 7.65% FICA tax on the contributions, which is great. It's a good advantage that solo 401ks have. Also, they let you do the lump sum contribution. It's a little bit annoying the way that they set it up, where you technically can do next year in April 15th of the next year, you can make the contribution. The account has to be open though by December 31st of the tax year you want to contribute for. So you can't like think of it in March the next year of like, oh, I got to open one of these for last year. SEP IRA is the only thing that'll let you do that. So you got to already know that you want to do this uh, by the end of the tax year. And then the cons are of, between SEP and solo 401k, there's a lot more administrative upkeep than a lot of people know. And it really starts to pile up later on in the life of your investment account. When you have $250,000 in your solo 401k, you got to fill out a form every year with the IRS called 5500. And it costs money. You should probably not do it by yourself. You should probably pay somebody to do it, an accountant or a third party administrator. Some brokerages will basically waive the fee if you have enough money or they like you enough. That's sometimes an option, but it is a cost and it's annoying. So SEP IRA will never require you to make a report. Solo 401k does. It's also the most restrictive of investment options at a lot of platforms. For some reason, a lot of brokerages say you can only buy mutual funds. And that's not a IRS or a legal, it's not codified that way where it's got to be this way. It's just how they do it. It is irritating that that is the case for a lot of folks. And also, people are often familiar with some of the fringe benefits of 401ks where you can make planned loans against the money that's in your uh, retirement account. Those are usually not available to most solo Ks. Some custodians say that they do this, but they functionally don't. In my experience, they usually are legally allowed to, but they're just not going to loan you money. Um, they might do that for a bigger company and a bigger 401k, but usually not a solo 401k. So some of the other advantages of 401ks that people are familiar with are not actually available with the solo 401k like they would be with a regular 401k. And so that's the main plans people need to be aware of. Individual IRAs also are really useful though for a lot of investors. A lot of times people will hear these big numbers like you got to make 276,000 for this to be something you care about and go, that's not even close to me. So that's maybe not that relevant to everybody. The individual IRA has a much lower maximum contribution. It's 7,000 for folks who are under 50. And if you happen to be kind of clustered around the median income, that's actually pretty reasonable. That might be about 10% of your income going to retirement. And if you're at the median or near that, that's probably about what makes sense for a lot of, especially younger self-employed folks to do. And so this really is the easiest possible uh, thing to implement. You just open an account at any brokerage or even banks offer IRAs, and they're the simplest to contribute to. Also very flexible, like the SEP IRA, in terms of being able to make a lump sum contribution backwards looking by the tax filing deadline. And so they are really flexible. Investment flexibility is the highest. You can even get into having self-directed IRAs where you like buy cryptocurrency or commercial real estate or crazy stuff like that. You can do that with an individual IRA and not the other option. So it's the most flexible, the cheapest. There is basically nobody charges money for these anymore. They are free at almost every single institution you could open them at. So they've got that advantage. Not every brokerage offers a SEP IRA or a solo K anymore. Vanguard recently has gotten rid of their solo 401k branch, for example, and everybody offers an IRA. So it's very easy to get set up with one pretty much anywhere you do your finance activities. For self-employed folks who are married to somebody with a very high income that is covered by a retirement plan at work, there are deductibility issues. There are limits that change every year in terms of, is your contribution deductible? That's the bummer thing for some people about traditional IRAs. And traditional just means you get a tax deduction for contributing now and you pay taxes when you retire. Roth is where you pay taxes now, don't pay them later. Some people are precluded from making a Roth IRA contribution if you have a certain amount of income. So that also becomes kind of a non-starter for usually married couples where one person has a lot of income that makes it so they can't contribute. If you are married and filing separately, the income limit is comedically low. It's $10,000 is the most you can make a year and still contribute to this. So it's not good. If you are married and filing separately, there's some serious issues. But for a lot of usually single, younger, more middle income folks, these are actually the best ones. There's the least to do, and they're the easiest to manage. So they are often overlooked, but for a lot of people, they are great. And there's a little bit of TLDR for the Oregon and California folks on one of the most common questions that you get asked when talking about retirement, especially for folks who have W-2 employees at the company, is, okay, I got a letter from Oregon. It says I got to have a plan in place by yesterday. Should I just use the Oregon Saves plan? That's Oregon's sponsored IRA program that meets their requirements for legally complying. And California has the same thing if you're in California. The thing to know about both of these is it is just a Roth IRA. Basically identical in every single way to a Roth IRA. And for some of your employees, the problem with that is they might be married filing separate because their spouse has tons of student loans. And so they may not actually be able to contribute to the Oregon Saves plan. And no one will explain that to them ahead of time. It creates a lot of potential headaches for your employees, and accidental stuff comes up where their married gross income is just too high for them to have contributed. So there's a lot of stress for some employees that this should be easy. It just isn't in terms of how Oregon has implemented and managed and communicated this. So that's a problem. Also, there's no tax benefit to your employees making a contribution in terms of reducing their taxes. If you have an Oregon Saves plan and they're contributing their money, they don't get to then open their own IRA and make additional contributions for tax deferral. They don't get to. And so that is pretty negative about Oregon Saves for a lot of people. Also, it's basically the least flexible Roth IRA out there. You could just open a Roth IRA anywhere and have more investment options. It's basically a Roth IRA that only lets you use a couple of State Street global advisor funds, and that's it. So you can't use any other ETFs or mutual funds or stocks all that you can buy is a couple of ETFs from State Street. And yeah, it's basically one of the least flexible plans out there. And for people who have W-2 folks, usually simple IRA is going to just be a better option all around in terms of everybody can make deductible contributions. You yourself as the business owner can. So it gives you the most advantage as the business owner. The only time that folks really should be thinking about this is if they really cannot swing the 2% match salary that the simple IRA requires. And so people can't. And so this is a place you can start if that's not feasible at this time, and still not get sued by Oregon or California. But for most people, they should probably be looking at simple IRA options. And then places that you do this stuff also come up immediately after we have talked about all of those things. And the thing to know about the brokerages, the places, the financial institutions you set these things up with, is that the top 3 largest and most popular are functionally identical in most cases. There really are not very many differences between Vanguard, Schwab, and Fidelity. If you have brand loyalty in general, you had an old employer plan that happened to be at Fidelity and you know how to use it, it's just as good as Schwab. I can already tell you, for most people's purposes, these are basically the same. One exception happens to be Vanguard, where they are getting rid of some of their solo 401k product offerings and shoving it off on this other thing called the census that nobody likes. So if you're loyal to Vanguard, be aware they may bump you off into some other affiliate company that you don't like. But that's the one thing to know. In terms of, do they all offer expansive options? Yeah, they generally do. Schwab is probably my personal favorite in terms of it's the easiest to do the paperwork to set it up and then manage it on an ongoing basis. Fidelity isn't always great at giving you the right paperwork to do in the first place. And it's not something most people care about, but it can come up, like if you get audited by the IRS and you never did the form, that can be a problem that you don't want to deal with. So that happens usually with Fidelity more than any of the others, but they're all great. I have mostly good things to say about all of them. And so they're all valid options, and anybody could consider any of them. There's a couple of comments, though, about Robinhood and Betterment that are worth knowing about, especially if you are, in the case of Betterment, if you use Gusto as bookkeeping or a lot of the other inexpensive options for bookkeeping services. Betterment has really good integration for a couple of options. It's good to know about specifically for that situation. Robinhood, if you are a person who said, okay, individual IRA kind of sounds like what I should be doing from what we just said, Robinhood is your easiest option. It is the easiest to set up an account, but also in terms of using the interface. If you've never done any investing before and you set up a Schwab account, oftentimes it's not that user friendly. The same is true of Vanguard and Fidelity. It's a little bit of a learning curve with these. Robinhood is the easiest if you've never done anything. If you just want a basic IRA, they make it outrageously simple to do on your phone. It's free. Trading almost anything that you would want to trade is also free. And they have some really good other benefits that would show up if you start really paying attention to the differences between these brokerages. They let you do fractional share purchases if you buy ETFs, for example, which are exchange traded funds. Great investment option for probably anybody listening to this. ETFs should be one of your first choices. They will let you just use straight dollar purchases. So you don't have to calculate how many shares can I buy round shares like Schwab and Vanguard make you do. It's very easy to work around that. Also, they let you loan out your stocks and ETFs and get paid by people who want to borrow them. Schwab doesn't do that for most people. And dividend reinvestment's really easy to set up, so you just have cash piling up. Also, if you do automatic investing, like you're not a person who wants to go in and press the buttons and make trades, it's the only one that has truly automatic, completely flexible, ongoing investment. If you want to make a contribution every month to your IRA, it's probably the best one if you don't happen to enjoy trading. So it's got some real advantages for most people. It tends to be branded as very millennial. Millennial and younger is kind of the target audience, but I work with folks who are 65 and have Robinhood accounts, and they like it just as well. So it turns some people off of it if they are older, but just as good for their purposes too. The one thing to know is that only offer individual IRAs. So both Roth and traditional, they will let you have, but no SEP IRA, no simple, no solo 401k. So that's pretty limited in terms of applicability. They also allow you to basically buy whatever ETF you want, but if you for some reason need to buy mutual funds, you only buy mutual funds. They have no mutual fund access. So that's a non-starter for some folks who are particularly loyal to, say, a fund company that only offers mutual funds and not ETFs. It's important to know that ahead of time if that's an issue for you. Usually, if that's you, Vanguard or Schwab are your top choices if you're a mutual fund only person. And betterment also is a really important one for folks who have employees and want to do something that was not on our little list that we just talked about called safe harbor 401ks. If you are a person who said, I liked everything about the simple IRA spiel I just heard, except I want 23,000 maximum contribution instead of 16,500, then maybe some of you, the safe harbor 401k is probably exactly what you're looking for. Safe harbor 401k was based off of the simple IRA. The IRS said, hey, let's just copy this and put it onto the 401k and up the limit for contributions from the simple IRA. That's how it came to be, and it's still that way. It's got all of the other stuff that we said about the simple IRA, basically. So Betterment is one of the best options if that's what you want to do. Vanguard doesn't do this particular kind of 401k anymore. Schwab probably will discourage you from doing it. They just probably don't want to deal with you. And Fidelity also has greatly discouraged most people from onboarding with safe harbor 401ks. So it's tough to get in the door with a lot of options. Usually Guideline is the one that you'll hear the most about if you're a Gusto user, especially. There's an integration with Guideline. Some of you may already use Guideline. Betterment has the same integration with Gusto. So if you're like worried about that, you want to have a safe harbor 401k, Betterment is awesome. Great alternative, I think, to Guideline in particular. Mostly because it's got one of the best 401k safe harbor fund lineups. So 401ks that are not solo 401ks will restrict your investment options significantly to mutual funds and usually specific mutual funds. Betterment has a really good lineup compared to, say, Guideline. So I like it quite a bit for folks who are considering going with Guideline and setting up a safe harbor 401k for the employees. It's also just one of the cheapest 401ks, especially safe harbor 401ks out there. It costs extremely little to get set up with them. The all-in cost kind of changes over time, but usually it's just a couple $1,000s. Other plans might be twice or three times that amount in cost getting started. And so good one to know if that's you. The limitation here is it's just limited to safe harbor 401ks. They don't have great SEP IRA, simple IRA, solo 401k. So it's really just a niche topic here. um, Definitely 401ks in general may not be worth it for you unless you have at least 15 employees. Good to know. And they will tell you that once you onboard with them and you do an interview. They'll say, really, you probably want to have at least a dozen, if not, 15 or so folks. Otherwise, you might want to have a simple IRA in the first place. And so that is the rundown of plans and places to invest at. And I like to give the minimum amount you need to know about investing to in this topic, which this is like lightning round crash course on what do you absolutely need to know about operating your own retirement plan. And this is the shortest we could possibly do this. So if you've ever wondered, like, what is the least I need to know, this is it. And it's a lot of information in a short amount of time. The most important thing for you to know as a person setting up a retirement account, wondering, can I actually do this on my own? Do I need to be a specialized expert in investing? You really need to know the fact that there are only two investments, really. There is many thousands of investment options, tens of thousands, really, for most people. But they all boil down to being either a stock or a bond for the most part. International stocks, real estate, gold, Bitcoin, they all are in the owning category, and they all owning style investments resemble each other in terms of how much risk you're taking to buy these and how much money you're going to make as a result of owning them on a big time frame. They all compare to each other. And then loaning, that's the other investment activity you got. And for most people, that's bonds in your portfolio. And if you've ever wondered what a bond is and heard it a lot of times, don't know what it is a loan that you make to either our government, the US Treasury, or companies or international governments. But that is all it is at the end of the day. So you got owning and loaning. These are your two activities. And it's going to be really relevant to this next slide, which is, if you have ever wondered what is the technically right way to do investing, as in this is what every investment manager does every single time, it really boils down to this chart. This is the hierarchy of decision making. It's the same for everybody. It's actually an international standard in ISO. This itself is from the ISO. So if you've ever wondered what is the technically right way to set up my retirement account and invest in it, this is what you got. The most important decision is how much time do you have as an investor? And I have another chart that explains why this is true in a visually accessible way for folks. This may be some of you out there. In fact, this is a couple, age 40 and 39. So this is from a real financial plan. This is people who are saving for retirement, and they're going to retire in their mid 60s. And what you'll notice is the whole left side of the chart, the best and the worst outcomes are very close together. This is 500 different trials of the exact same portfolio. So these are probability model of what happens to your money over time. And for the most part, whole left side of the chart, they're really close together. Best and worst outcomes are not that far from each other because you haven't sold anything. You haven't made any actual distributions from your plan. You just keep buying when things are low, you buy when things are high. It smooths out the outcomes for the vast majority of investment outcomes. Things get really interesting, though. It basically explodes when they turn 65 and they start taking money out of their account. That is where volatility really starts to matter. And paying attention to your investment strategy really now matters because your best and your worst outcomes, you have locked them in, so to speak. You've sold stuff at a high or you sold it at a low. You took it out of the account and it's not going back in because you're retired. So that is why it is the most important investment decision you got. Volatility for most people, most of the time, shouldn't be your number one concern. Really, how much money can you put towards retirement in the first place is your most important concern, and how long you got to invest. So that is time, amount of risk and return to take, also your second most important decision. The reason that this matters for most people is the worst outcome that can possibly happen as an investor is you took more risk than you bargained for. And you only realize that that's true when you are already freaked out and you are now selling because the market is tanking. This is one of the worst possible outcomes, but it's also extremely common. So it's the thing that it's most important to know ahead of time before investing how much risk you actually want to deal with. If you already know you're a person that's inclined to like panic sell while everybody else is doing that, it's best to just take less risk in the first place, because that is much more important than did you buy the right stocks? Did you buy the right bonds? That's actually a much less important question than are you going to hang out in your investment strategy for the next 3 decades? That is an extremely important topic. And then the next thing is asset class mix, which is a fancy word for how many stocks versus bonds do you have. The reason that this is so important, and it's still way more important than whatever individual investments you pick, is that there are great studies out there showing the mix of these two things, stocks to bonds, in your portfolio predicts the vast majority of returns and risks you'll ever have as an investor. So the most comprehensive study out there said 92% of all of the risk and return that's ever going to happen to your portfolio are just due to how many stocks and bonds you have. That mix is the most predictive thing in terms of investment outcomes. So if you're wondering, how do I spend my time in investment decision making? This is one of your most important things. It's just how many stocks, bonds do you have? And I'll show a little chart on what happens to a moderate investor if you're like starting to wonder how this actually plays out. I have a specific example for you in a moment. Next thing below that, stocks to bonds, is the next layer, which is what we call sub-asset class, which is if we know how many stocks you want, okay, now within that, how many should be international versus US? That's still way more important than which particular stocks and bonds you picked. Is which flavor of stock did you pick in terms of, is it a big international stock? Is it a small US stock? This is much more predictive of your outcomes than the specific choices you make. So it's also an important decision. But for most of us, just a mix of international to US, that's really your most important sub-asset class decision to make. And the very last thing is the individual investments. And so for most people, they worry that this looks the opposite of how it looks. They go, oh my gosh, how do I know the specific thing that I should buy? That's your least important decision in the whole process. It means the least in terms of how much money you will make. And so if that's, stopped you in the past, you say, I might pick the wrong thing, be aware that you can still do a really good job. If all you did was get the other things, knowing how long you're investing for, knowing how much you want to lose potentially, knowing how many stocks to bonds you're going to have. If you've done these things, you've done the vast majority of the investment process. And that's really where you should spend your time annually when you do rebalance or setting things up. Asking and answering those questions is by far your most important thing to do. And then picking the individual investments is the very last step in the process. And once you've done all those things, you've done investing right. And the big things to know, there's two investments. Time matters profoundly, in stocks to bonds is the most important thing. And that's pretty much all you need to know about investing for the most part, just in terms of getting started with this process. I do have the life of a moderate investor. If you've been wondering, okay, I know I'm in the middle. It's frankly a lot of us tend to be in the middle now. How do I actually invest with this in mind? This is kind of the life flow of somebody who is in that bucket from 20 through 72. And on the young side, you have far more stocks and bonds. 70-30 mix of stocks to bonds is the most common for a young, moderate person. And within that, about half tends to be US stocks. In this particular year, I probably would say something a little bit different if we happen to be individually talking about what should I do this particular year. I'd probably say more international stocks than 20%, but that changes. And then 30% bonds. That's all you got to do. And by the time you're in mid 40s, you might be interested in a little bit less risk than that. The 60-40 mix of stocks to bonds is the most popular mix of all portfolio configurations. It's the most commonly recommended. Most people kind of land somewhere around there if they are just picking investments by themselves. So it's a well-known investment strategy. You do a little bit of dialing down both international and US stocks to get down to 60, and you dial up bonds to 40%. You're still not doing anything other than just buying the same investments, basically. You just change the mix a little bit. By the time you are in your 60s, a moderate person probably has about half and half. They may have stuck with the 60-40 and do that forever, but moderate, right down the middle, you probably are closer to 50-50. And now you possibly care about cash because you're going to actually be taking money out of your investment accounts. And so having cash hanging out to make your annual distributions now matters to you. And this is really the first time that it makes sense for most people to have cash in their retirement account. Having cash is not particularly advantageous until you hit your 60s. So if you've wondered, like, is there some recommended number of cash that I should have for some reason every year? Probably not, unless you are in your 60s for the vast majority of us. And everything else, you don't need to make it particularly more interesting than that if you don't want to. And that is kind of the life path of an investor here. In 72, the reason it says 72 is not because most people will die at 72. Most of us will live more than 72 probably. But who you are as an investor greatly changes by your 70s. By that point, you should probably talk to somebody about how to invest as a what we call a mature retiree. You've probably had massive personality changes around money by this time. You also have Social Security, you may have pensions. a lot is different about being a 72-year-old versus even a 65-year-old. And that's why it ends there, is it gets a lot more interesting for those folks. And I have a couple of resources for folks that are interested in getting started and wanting to learn a little bit more. Thebalance.com is one of my favorite websites for the basics of learning about investing, because the bummer thing about most financial media is it's kind of meant to induce you to spiral and go down rabbit holes and frankly hire somebody and pay somebody a lot of money. Uh, Balance.com is written in a way that most people can read. It's not toxic. It's not telling you you don't know how to do this. And many places actually will just explicitly uh, make you feel bad about yourself. So that's what I like about the balance.com. It, I think, is the most accessible and freaks the least people out. Investopedia does start to get into the uh, kind of bullying you into thinking you may not know enough. Also, it's just written very technically. If you want to know some of the very niche specifics about some of these topics, like how do I calculate my uh, adjusted net income for my SEP IRA, Investopedia will answer that for you, but it will answer it in financialese, as we call it. So may not be intelligible. So, for more advanced investors, usually Vox.com does really good kind of alternative views on finance and economics. If you have ever checked out Wall Street Journal and been like, this is not for me, this is a perspective that is maybe just like leans the wrong political way, Vox.com is really great for people who are bummed out by some of the other sources. I'm personally a Bloomberg person, which is right down the middle. That's another great option, but Bloomberg it costs money, and so recommend it less often. Not everybody needs to pay that much money just to know the news about markets. In terms of resources on researching the individual investments, so by the time you've got to stage 5 of our order of operations, you're ready to invest, Morningstar.com is by far the most popular resource for these purposes. It's a great research tool for mutual funds, stocks, bonds, ETFs, pretty much anything. So it has great information on past returns, risks of investing, the costs of investing, importantly. They are displayed really prominently anytime you look anything up on Morningstar.com. They have unfortunately paywalled more content every single year, and so it's like more freemium at this point than it once was, which is kind of sad. But in terms of what do investment professionals use, we universally use Morningstar.com. It's an excellent resource that would definitely give you everything you need to know. If you are more of an ETF person, so if you know about ETFs, exchange traded funds, and you really couldn't care less about mutual funds, particularly, Morningstar.com is tilted towards mutual fund content. It's still, most of their readers are mutual fund people. If you are really more interested in ETFs in particular, ETFDB is a very, very popular free site that has a wealth of information. It even has really great socially responsible information for folks who are, that's top of mind for you. So you really wonder about social, environmental impact. ETFDB has a great tab for pretty much any ETF out there. And that part is free, which is awesome. Morningstar, this is no longer free. And if you really need even more of a crash course in investment choices, Mutual Funds for Dummies is actually a really good book. It's unfortunately named, in my opinion, but it is actually a legitimately good resource that is comedic. It is not too serious. It is not written in financialese, which frankly we've done a fair share of today. So it's got advantages if you just want to read a simple, easy to understand book on how to even get started with this. And also some tickers for people who want to just buy a thing. They want to buy one thing. There's a couple of those up there from iShares has a more conservative one. SPDR, State Street, they have a really great global moderate one. And if you're interested in socially responsible but do not care about knowing anything about investing, really, iShares has a great fund for you, which is the EAOM ticker. It's a balanced fund between those. And then Vanguard's target date retirement funds. For some people, they really do not enjoy this topic and they just want to buy a thing that's going to be the same every single year. You can buy that through pretty much any of the brokerages we just talked about. You don't have to go to Vanguard to set it up. You can have Vanguard target date funds through Schwab or Fidelity or whomever you want. Guideline has them as well. So does Betterment. They're a great, like, I don't want to make any decisions investment option too. And you can research those. They have a page on their website about what they are. And that's all I got for you today.
Thank you so much, Chaim. And the slides presented here are also going to be linked in either the description on the YouTube page or on the website, so folks can actually click these links and do further digging.
Excellent.
Yeah, thank you again so much for putting this together for us. Really appreciate it. I get a lot of questions from folks about retirement, so hopefully this can help folks steer in the right direction.
Awesome. Yeah, and people can also get in touch. Chaim Investment Advisors on Instagram, if you're an Instagram person. Chaim Investment Advisors YouTube, chaimvestmentadvisors.com. Feel free to be in touch if this is very confusing to you.
Awesome. Well, thank you so much for watching and have a great day.